Hello, I'm Eric Ludwig, and I'm going to go through a couple slides that I created, which is just a recap of 2022 and answering the bigger question, what should I do now? So I'm going to share my screen, pull this up. All right, here we go. So I titled this 2022 Halfway Recap as of June 15th anyways, of 2022. What should I do now? Okay, so year to date, what's going on in the world? We have a war, a pandemic, labor shortages, supply chain issues. The Fed is starting to tighten, and part of this, whether it matters of what the link of causation is, the supply chain issues are causing inflation. So the question is, what is the effect of that been on stocks, and the effect of that been on bonds? So inflation in terms of stocks, anyways, that hurts corporate earnings, and then corporate earnings, of course, affect growth, or in this case, the lack thereof. And just try to keep this in mind, because we're talking about a growth story here for stocks, not a bankruptcy story. And I'm going to focus on that here in a little bit. What about bonds? Inflation, of course, makes yields go up on bonds, which is good for savers, right? But it makes bond prices go down, and bond prices are the thing that you see on your statement. The thing that you also should be seeing is the cash flow, which has actually typically gone up this year. Okay, so what does this look like visually? On this chart, I have a couple different indices. I have in the dark blue line, the thicker one is the S&P 500, which is what most people think about when they think about the stock market. This is year to date, and then we have, as sort of a comparison, the purple line is the Russell 2000, which is small companies, pretty much the same thing. And then the light blue line is the NASDAQ, which is, tends to be technology companies. And you can see that one's down a little bit worse. Okay, so here's what's been frustrating about this year so far. Bonds are down too. And depending on the type of bond, they are down just as much as stocks. So in the dark blue, on this chart, we have an index fund that tracks all US bonds, kind of in different weights. The light blue line is high yield bonds, which are also known as junk bonds. And then the pink line, check that one out, that is long-term bonds. So those are government bonds. Anyway, so there's actually something really important about this graph. So not just that bonds are down, but in this distinction. So why are bonds down? We expect bonds to go down when interest rates rise. We expect that, right? And then the longer the maturity of the bond, the more we expect to see prices of those bonds be down. So that pink line is 20-year government bonds, which means that they have almost no credit risk, right? Like no risk of default. These are government issued bonds. And we see that high yield bonds are not down as much as long-term bonds. So why is this important? Because bond traders are smart. What this tells us is that the market is not afraid of like companies defaulting or filing for bankruptcy, which would be the actual main concern with a recession, right? But that is not what is playing out here. This is purely a reaction to interest rate movements only. Here's how bonds reacted during the great financial crisis in 2008, 2009. So here we can see kind of the bigger concern at that time was a risk of bankruptcies, right? So how can we tell? Well, if you don't remember, right, the purple line on the bottom is the stock market in this picture. And we can see it basically perfectly correlates or follows junk bonds, which is that light blue line. So, but check out the long-term government bonds in this chart, and which is the pink line. And we can see that the long-term bonds in this case provide almost a perfect diversifier. It's like that one zigs when stocks are zag, right? So it's this perfect correlation or opposite correlation. And it's the same with the index fund bonds in that dark blue line, which other than a minor hiccup, at least they held their own. And so that's why this year has been so damn frustrating. It's because everything's kind of been moving down in tandem. All right, I just want to make this final point before moving on. So let's look at the time frame surrounding COVID-19. So this is January 2020 to May 2020, and we see a similar reaction to stocks and bonds as to what we saw during the great financial crisis. So again, stocks in purple, and the high risk bonds, the high yield bonds in light blue got smashed, right, in those initial days, initial months, while index bonds held their own. That's the dark blue line. And the long-term bonds provided, like, again, that perfect diversifier like we saw in the financial crisis. So the point of the first point is to simply make the point that markets are not concerned about bankruptcy and recession. The concern is about the effect that inflation is having, especially on bond prices, like how we started this, and corporate earnings, corporate growth. So this is just bond math. And again, the concern is not on like corporate, or the concern rather is corporate growth, but not like corporate failures like we were worried about during COVID or the financial crisis. So what is the implication of this? So inflation or interest rates are driving the market, that's for sure. But once that cools down, both stocks and bonds will rebound. So this is my opinion, in accordance with this kind of the same running hypothesis here, is that bonds will actually take longer to recover versus stocks. And we'll touch on this in a bit, but I just want to make the point that if an investor wants to take their portfolio down like a risk level and hold more in bonds right now, that might actually be the worst thing to do for helping your portfolio to recover. And I'll kind of make that point more here in just a bit. So, all right, first let's follow that example all the way through from COVID-19 and start looking at the impact that certain decisions would have had on someone's portfolio, not just in the recovery in the last 2 years, but like zooming out even more and following it through to today with this tough last 6 months that we've had. So we're starting this by looking at a 60-40 stock bond portfolio, or actually, I guess it's a 50-50 stock bond portfolio, which is like a balanced portfolio that many clients have, especially retirees. And we're starting this looking at the beginning of January in 2020. And so we follow this balanced portfolio all the way first to the market bottom, which is, you can see on there, March 23rd of 2020. And let's look at 3 hypothetical decisions that somebody made. So first, do nothing. Second, go to cash, all cash, right? Just sell everything, go to cash. And then third, go to all bonds. And so what do we see? Well, it turns out that going to cash locked in that 17% loss, and then it just stayed there, right? So, do people do this? Yes. Thankfully, I only had one now former client do this, and I know for a fact that he did not reinvest. So what about going to all bonds, right? That's another decision that someone could make, and like freeze the portfolio is the term that I hear people say sometimes. It turns out that was actually worse than going to cash. So that investor, while you can see recovered a little bit for about 2 years, has actually dropped even worse than the all cash guy and is down about 22%. So that's the effect of going to all bonds at the bottom. What was the best case? Well, it's just stay the course. So even with the bad performance that we've had this year, it's still about 8% above water from the January 2020. And that is the benefit of having this wider horizon or this longer view. And so we're going to keep focusing on that the last few slides here. So how does this year, 2022, compare to other bear markets? Well, this is the table of the top 10 worst years in the stock market. So not bonds, just stocks. And the year's only halfway done, but if the year were to end right now and we see where we fall here, we'd be in one of these top 10 worst years, somewhere between like the dot-com crash about 20 years ago and that 73, 74 bear market. Well, as many astute listeners will point out, very few investors invest only in stocks, and it probably makes more sense to look at like a 60-40 portfolio or like this balanced portfolio. All right, so many of the worst years for a 60-40 portfolio are the same as the worst years for the US stock market, which makes sense, right? Because since the 60 of that is the stock portion, which carries more risk than the 40 in this equation. And while the current loss in the S&P 500 year to date would be the eighth worst calendar year return since 1928, it's even worse for the 60-40 right now. If the year were to end today, the current year to date return for a 60-40 portfolio would be actually the sixth worst annual return over the past 100 years or so. So since bonds are having such a rough go at it during a correction in the stock market, this year is currently on par with 60-40 returns in 2008 and 1930, which is not the kind of company that you want to keep. Of course, we're only 5.5 months into the year, and even if the year were to finish where we are right now or worse, it's just 1 year, right? So you should expect to have bad years when investing, because investing is not always easy in the short term. We know that. What about the long-term returns? That's the only ones that matters. And that's what I want to focus on next. All right, so these are 5-year returns for the 60-40 portfolio, but these are the worst 5-year returns. So I'm going to say that again. These are the worst 5-year periods, not average, but the worst 5-year periods. And so we're looking at 4 times that we've had a 5-year period when a 60-40 was negative over 5 years. And if you look at this, they all occurred around the Great Depression. All right, now let's go out 10 years. And again, these are the worst 10-year periods for a 60-40 portfolio. And by my calculations, there has, oh shoot, I put the wrong chart up here, but there's actually never been I wonder if it's on the next slide. No, I sorry about that. But there's never been a negative return over 10 years for a 60-40 portfolio. So could it happen? Yeah. But there's no such thing as always and never in the financial markets, but still this is a pretty damn good track record. And sorry, I didn't have the right chart up here, but let's zoom out even further. So one more here. So these are the worst 20-year returns for a 60-40 portfolio. And as with most worst case historical performance numbers, the starting point for the bottom of the barrel was in 1929, right? So this is that Great Depression time. And it's interesting that the years ending in 2018 and 2019 are on this list, right? The height of the dot-com bubble was not a terrific entry point, right? So we're talking about before the dot-com crash, not after. But right before, that ended up with 2 of the worst 20-year returns. But we're looking at numbers there, by the way, of 245% over 20 years. So not horrible. So it's worth pointing out that the average return of these is actually 6%. And remember, this is the worst 20-year periods, not average. I'm not accounting for fees or taxes or inflation here, but it's still a pretty good outcome for worst case scenarios, right? And it makes me wonder how many investors would sign up right now for a guaranteed 6% return for the next 2 decades. Well, buy and hold will probably do much better than that even. So here's a point: the long-term returns after the worst years are actually tend to be some of the best. So in the average case, which I didn't show, is 35% for 3 years and 80% for 5 years. And I don't know what's going to happen for the remainder of 2022. There's nothing that we can do about the losses that we've already experienced. It's a sunk cost at this point, right? But the important thing to remember is that the lower that stocks go, the higher your expected returns are going out into the future. And so lower stock prices are actually a good thing for long-term investors. You just have to be patient, right? As far as things go, From a timing perspective and making portfolio changes go, I just want to leave you with this final thought. So that is that there is no reliable way to know when a market will bottom. But what I do know is that the only reliable way to capture a recovery is by simply being invested when that comes. So that's all I got. Thank you so much for watching. I tried to keep this short. If you have any questions, by all means, send me an email. If you're watching this and you're a client, you have my cell phone number. And so I will leave it at that. All right, great. Thank you. And I hope to talk to you soon.